Henrik, thank you very much for joining us today. How are things in Copenhagen?
Oh, they're great. Absolutely great here. Summer is almost over now, it seems, but I think we business is good, so things are great.
So the last time we spoke, which was the first week of August, and at that time we had a lot of volatility in global markets, and that volatility came from the fact that we had weak economic numbers out of the US, and we also had the unwinding of this yen carry trade. But now here we are in the back half of September, and the markets have recovered quite nicely. Both the S&P and the Nasdaq have had big rebounds. The S&P was at 5,200 when we spoke in early August, and now it's at 5,600, give or take. And your target at that time was 6,100. We're only 10% away from that level, and you were calling for a blow-off top or a blow-off rally. Are you still looking for that move, and do you still have a target of 6,100 on the S&P?
Yeah, I think maybe I've said 61 to 6,300, but yes, those levels are still what I'm expecting and waiting for, and I think we'll have another pullback, let's say early mid October. I think there'll be the next one, and then I think it's straight for the top. But yeah, things are developing pretty much as I've been expecting it.
And when you say you're looking for another pullback in October, what's going to be the catalyst for that? And how severe will it be?
So I use structures to understand, see where markets are heading, and in that structure you would see that we'll see a new all-time high now on the S&P and the Nick sorry the Nasdaq, and then you'll see a pullback. And I think thinking that it may be around the NFP numbers coming out could be the first negative print we could see. Just a suggestion. Could be something completely different from that. So I do not know what the narrative will be around it, but it seems there'll be another pullback. It'll not be as severe as what we just saw here in early September, but there'll be a pullback. And I think that when that is over, and that is when we go straight to the top and I think my timeline is now not October, but it's more like November now. But we're getting closer and closer to the timeline of it, and there are many indications that we're getting closer also.
Now, the S&P is at or near an all-time high, but the Nasdaq is not. And we've seen a lot of volatility in the Meg 7 stocks, as everybody likes to call them. And when we spoke in August, the Nasdaq Composite was at 15,700. We're now at 17,600, so a nice move up, but we're still 1,000 points away from its all-time high. What are your views on the Nasdaq? Do you think we're going to take out this high?
Oh yeah, absolutely, and much more than that actually. And I think you have way more to go in the Nasdaq. I think again it will be more speculative into the final phase of it. So I think we're going to see, and people may pinch their arms to understand how fast these things can go actually. But if you look at it, I think we can go to 23,000 on the Nasdaq, maybe even 24,500 around that area. And I think that will be, that is the blow off top. And again, the timeline November-ish, like that. So we do not have much more time. It's more about the levels than it will be about when, but it's the indications that things are now starting to deteriorate in the economy, and also if you look at the momentum of the stock market, you can start to see that even though we reach higher levels, we do that under less momentum, and that shows that things are not great underneath the hood.
So let's dive in a little bit deeper into that because and talk about valuations. In the past, you have talked about the Buffett indicator, and as a reminder to our viewers, this Warren Buffett is an indicator. He says it's one of the best measures of market valuations, and it's a very simple calculation: market cap of the stock market divided by a country's GDP. And if it's below 100%, then he sees good value in the market, and if it's above 100%, then he thinks it's getting expensive. And the Buffett indicator is currently at 200%. And this is even higher than what it was back in the dot-com, which was about 150%. What are your views on this indicator? And do you think this indicator is still relevant? Maybe it's archaic. Maybe it's no longer has any bearing on what's happening in the marketplace.
We always hear when we get to these extreme tops that, oh, these are the old economics. We heard that in 2000. That's as far as I can remember, into a crisis, and we heard it also in 2007, and especially 2000. Remember, it was the new economy, because now Henrik, you have to understand that it was it was because we got the dot-coms now, and the internet, and it's completely different world. It's a new economy. And now it's the same thing we hear again, and we hear it from people that maybe have not lived through these times. or maybe do not remember them. But again, we hear the same thing. But if we just look at it and you look at the valuations we have in the stock market, you have the whole crypto market. It's just insane, and your level of speculation here, and especially when you look at crypto, you'll see that people are speculating whether one coin is better than the other and the reasons why, and you almost have this, fight of why one coin would be better, and all over the place. And you have a lot of, especially the private equity front, or your sector was also heavily influenced by the low rates that we have had for for decades now, almost not decades, but a decade and a half. So of course, when yields have been so low, rates have been so low, you've seen that the valuations have just gone through the roof. And now, at some point, when we start to see yields are coming up, we will start to see that actually the reality is that the companies cannot simply not carry this kind of value. So I think that goes for a lot of the stocks in the stock market. It goes for a lot of the private equity portfolio companies that you'll see around the world. And this altogether is just one gigantic bubble. And it'll be so easy to see a few years ahead, because everybody will be looking back at it and say, what were we thinking? But now we are right here on the bubble, and everybody who dares to suggest that the emperor has no clothes on is simply just not because he's not good at his job. And I dare to be that little boy and say, well, we'll actually the emperor, and that's the situation right now.
So the poster child for this current bubble is Nvidia, and it has a market cap of around $3 trillion, $2 trillion of which came in this year alone. And I want to compare it to the GDP, right? It represents 12% of the GDP of the US, which is just a unbelievable number. And when I look at this, I want to compare it to Cisco, which was the poster child back in the dot-com bubble of 2000. And that one, believe it or not, it had a market cap of around 550 billion, which is a lot of money now, never mind back then. And I think it got up to about 5% of the GDP of the US. And then in the ensuing years, when the bubble cracked, Cisco lost 80% of its market cap. Do you see the same thing happening with Nvidia?
100%. I mean, something that goes up like that in a straight curve, just going higher every day, it's just insane. So of course there's a bubble there, and how far down or how far it will decline, I don't know, but I could see much lower levels, and 80% would not surprise me to see to the downside when we start to see the decline. And I do see there is structurally some weakness in the price structure of Nvidia. So let's see. But obviously, we these kind of valuations is not something that is able to be maintained. 12% of the US GDP is just insane. But again, it's difficult for people to comprehend, especially people that may have invested in and done well in getting into stocks like this. Well, it's good for them, but still, it does not change the fact that this is a bubble. And we'll see. Again, I think it'll be much easier to see in retrospect. People find it so difficult to look at it now, and then they will come up with all sorts of reasoning or reasons why this is not a bubble, and looking at forward earnings and things like that. But guess what? Maybe forward earnings are not achieved actually. So it's like these kind of things, and so let's see what happens. But it's, in my view, there's no doubt.
So if you take the all-time high on Nvidia, it got up to $140, and 80% of that, or if you see a drop of 80%, that would take it down to $30 a share.
Yeah, I haven't checked the chart just recently here, so but would not mean I can't remember where we have some support in the price, of real support, because a lot of these things that were just been going up, it's just like it's air. So there's not too much strength behind that, and when things are starting to unravel, you will see some of this coming out really quick. But again, I may be surprised, but I don't think I will.
So let's look at the Nasdaq, okay, because that's where most of these high flyers are. And once again, I'm going to compare it to the dot-com bubble of 2000. And the Nasdaq peaked in March of 2000 at 5,048. It bottomed in October of 2002 at just over 1,100. That was a pullback of 78%. Do you see the same sort of correction happening in the Nasdaq this time?
Yes, actually I do. This is quite interesting because I was doing quite some extensive analysis on the Nasdaq just the other day, and I think I think actually if you look at it in just a normal recession, we would see a 50 to 60% retracement of the Nasdaq. But especially this time around, just like in 2000, we are actually in a tech bubble. Especially, it's a more than a tech bubble than it was like in 2007 actually. So I think the resemblances when it comes to the Nasdaq retracement will be more like what we saw in 2001. And I think it again. We have a lot of companies. We have Nvidia. We have others that have just gone through the roof, and a lot of this value is going to come out very, very quickly. So I think we could be looking into that. Again, it'll not be a straight line. There will be different phases in this crisis, and I think that the first phase of it will be rather fast. It'll be deflationary, and there will be a second phase to it after the Fed has entered. Actually, so I think, but when it bottoms out after the crisis, yes, I could see a very deep recession and very deep pullback retracement in the Nasdaq.
So what's going to be the catalyst? Because when I look at the economy right now, the economy is still growing at, I don't know, where is it? Somewhere between 2 to 3%. Unemployment rate, it is ticking higher, but it's at 4.2, 4.3%. I believe the long-term average is around 5.5%. Things look pretty good to me when I look at the economy. What is going to be the catalyst to take this market down?
I don't think the economy is growing at 2 to 3% at this point. I know that we had a GDP number at 3%, which was the first number coming out, but then you always have revisions, and you also had revisions on the first number coming out in Q1. But if you look at the consumer right now, then the U.S. consumer is struggling and has been struggling for quite some time, and we see that. Again, credit card delinquencies is one thing where we can just take a look and just say, well, why is it that we see those actually now rising at a rate of change, which is faster than going into the financial crisis? And there are simply also just the payments, the interest payments that we see from on consumers on their loans is just also through the roof. And we don't see retail soaring, and we just have very low retail sales numbers. So I don't see that we're growing at that level. I simply don't see that. And I think that when we look also at we've seen all the revisions to the NFP numbers. I think we are in the twilight zone where things are not really what they seem to be. And in this twilight zone, it may seem that we have an economy that is strong, but it is weakening, and the weakening will be coming out through the job numbers, and there will be some surprises. And if you look at the last two NFP numbers, they have not been great. And if you look at then the four last ones, and you look at them after the revisions, sorry, difficult to say here, then you will also see that we had one number below 100,000. It was 89,000. Was it? I can't remember if it's July now. Right, don't have the number here right in front of me. But anyway, was here one of the latest ones, and that is not a good sign. And so the economy is not as good as everybody seems to believe it is. And the numbers, the NFP numbers are, you have to take them all with a grain of salt. So let's see what comes out when we do the revisions on the GDP numbers. And we know also that when we actually do that follow up on the numbers, down the road, and we saw in 2008 also, you had to take all the GDP numbers, and they were just, had to be revised completely. So what we look at is an economy that has been under severe stress, or the consumer is under severe stress, and I think it's not spreading into anything yet because we don't see the really spike in the unemployment, but that's just a matter of time. And the leading indicators that I follow tells me that any day we can see very bad job numbers coming out. That could be in the initial claims, although that could be in the NFP numbers, or in the revisions of the NFP numbers.
Do you think the numbers are being manipulated ahead of the election when you look at the GDP numbers or the unemployment numbers?
I come from a country where we would I don't think it would happen here, but you probably know better, than you live close to to where these things going on. So I think I don't think they're being manipulated. I would hope not. I dare to be so naive, but I think that they are just wrong, and I think it's wrong because of the way that they do the surveys and all that on this. So I think it's simply we see that all the time. We've seen it into every crisis that the NFP numbers come out, and they are actually revised down considerably into the last phase of the business cycle, and this is where we're at right now. And talking about that, just how do you know it's the last phase of it? Well, because of the business cycle methodology, or the business cycle yeah, the way I do that, and I observe the business cycles, you can see that one of the things you can see right now is the 2-year yields is actually just plummeting, and that is a very clear indication that something is wrong. Something is not good here. Why would we see the market demand for capital is just declining as fast as it does right now? And you can see the mortgage applications as at 30-40 years low right now. It's because something is not right. People are simply not in a position where they say, hey, we want to take out a new mortgage loan so things are not as they seem to be. And I think it may just be because of bad techniques, bad ways of collecting these numbers, that we see these numbers getting revised all the time.
So let's talk about the Fed. And Jerome Powell was hanging out with all his buddies in Jackson Hole, Wyoming recently, living the good life. And I'm going to throw out a fun fact about the state of Wyoming, and more specifically in Teton County. It's got the highest concentration of billionaires on a per capita basis than anywhere else in the US. Can you believe that?
Wow, okay. I had no idea. Okay.
Anyhow, during that speech, during a speech at Jackson Hole, Powell said that the time for a change in interest rate policy has come. And so that implies that we're going to see a cut this week. And what are your thoughts on this? And we've been talking about interest rate cuts now for almost a year. And do you think the Fed is late to the game, way behind the curve by cutting so late in the
I don't
cycle?
know how many times I should say way before I say late to the game, because it's simply non-understandable. I really do not understand what they're looking at. So if you do a comparison across the board and say, okay, what was the GDP growth just before entering the financial crisis, before the dot-com crisis, and you look at the unemployment numbers, and you look at inflation, and you look at everything, you'll actually see that we are at a weaker place than we were before those two crises. And we sit here, we look at oil is down, substantially over since May, and is actually, if you just look a little at that, the direction of things, actually declining at this point, and has been doing that for some months. Whereas in the 2007, we actually saw oil was on its way up, and we know how oil is actually driving a lot of inflation. So I simply do not know or understand what. Oh, sorry, and I just need to complete that. And then in 2007 is actually it's 20% higher than we were when we are now, and now they're afraid of inflation. I mean, what has happened is really what I thought would happen actually also, and I hope I've said this on one of your shows, but I thought that I was thinking back in a year ago that it's what the Fed is going to do is get spooked by their own genie that they kind of think that they've let out the bottle now with the inflation ghost, so to speak, right? And what they kind of misunderstand is that they are not, of course, they are part, culprit of that. But really, the situation was that everybody in the whole world was stimulating the economy at a time where the supply chains were breaking down because people had to go home with COVID, due to COVID. So that is creating inflation. And now it seems like the Fed wants to, to get into the 0%, 2.0% inflation level before they let go of the handbrake there. Problem is, the economy, the real world, is just struggling right now. And what you see is that the inflation rate, their mandate, one of their key mandates, is a lagging indicator on the economy. So if they simply miss that, they are been breaking for way too long, way too long, and we are 6-9 months too far into this. And yet they are still, kind of have been kind of hawkish, I would say. Yes, they're going to cut now, and they're going to cut by 50 basis points, and I was expecting that. But if you look at it, you'll see the market yields, the 2-year market yields, is actually telling us this. I think they're 1.7% behind the market yield, and 1.8% behind. So the Fed fund rate and the market yield is 1.8% behind that. That is historic compared to how far behind they have been, in before other crises going, 20, 30 years back. So they are just, oblivion about what's going on in the economy and where to look. I mean, I'm really seeing this as it's not just a policy error. I think this is, it is a policy error. But it's such a big one that it's, almost, yeah, it should be criminal. I mean, it's so bad. So yeah, they are way behind, and they're going to trying to soften this by panic cutting into the next coming weeks and not weeks, months here. And so we will see, I think, 50 on Wednesday, and we'll see We will see much more to come into October, November, December, and so on. And in coming first quarter of 25, Fed fund rate will be at much lower levels, but it will be not enough. The downward spiral now, the deflationary spiral now, is now having its own momentum, and that is what it is forcing the economy down.
So in essence, it's going to be too little, too late.
Yeah, too little, way too late. Yes.
And there's this ongoing debate on whether or not the U.S. is in a recession. What are your thoughts on that?
No, it's not in a recession at this point here, because I think, and even though I don't trust the numbers that we see, but there are some numbers that I do trust. Initial claims, I have a pretty good idea of it, that I think we don't. And there are other indicators. I have a range of 20 indicators that would tell me when we get into that recession, and there are some that have been very precise in getting the month before we get into a recession. So I'm looking for those, and one of them, and there are some. Yeah, it's not just the 2-year yield, but one of them is the 2-year yield, actually, because we can say that when the momentum starts to get at a certain force in its downward spiral, then you'll start to see that's when the recession is there, and we're not there yet. So things have not unraveled yet. But the problem is that the Fed thinks that they can micromanage the business cycle to the degree of, oh, we'll just put a little salt on here, a little magic on it, on the economy, and then everything will magically just turn the other direction. And they just have to look to history for 5 minutes and then understand that there is a momentum of its own. It's a super tanker, and when you start to turn that super tanker, and you keep turning it on the rudder there, you just keep turning it into the recession direction for too long. You cannot just all of a sudden just to go the other direction with the rudder and just say, okay, now we'll not get into a recession. Things have started to unravel, and it's going to be bad, and we will see more of these fallouts. We'll see. We're not in the black swan environment just yet, but we are getting closer to it. And the moment we see I think the dollar is going to decline, and the DXY is going to decline a lot. But the moment, let's say December, we start to see the dollar moving up again, that's the moment when I think the black swan environment is here, and that's where we could start to see some serious fallout of financial institutions, companies, whatever it's going to be, that is, countries that could be in trouble.
Maybe you can expand on that when you say a black swan event. What exactly do you mean by that?
Yeah, so when the things are starting to deteriorate in the economy, it's not like it's not a trigger that is going to come. It's like, I know that's a common notion that everybody says, what is the trigger going to be? But like in the financial crisis, it was not Lehman Brothers that triggered the financial crisis. It was not even Bear Stearns in March that triggered the financial crisis. What triggered the financial crisis was that there was too much lending and too much too excessive greed, and also that we wanted to earn a lot of money by just investing and speculating. But all that speculation, that was in the real estate sector back then. And what we saw then was that as the economy deteriorated and fell into a recession December 2007, then you saw that as the consumer was then becoming worse off all the time because they lost their jobs and so on and so forth, then they saw financial institutions started to wobble, and we then had that crisis. That is what's happening every time. Then you have a financial crisis. You'll see that things are starting to unravel in the economy because there's been too tight monetary policies, and the inflation rate has been running too hot. Then the interest rate goes up, and it's getting a problem, becoming a liability on the consumer. Into that crisis, that is the moment where things are starting to unravel, because the consumer is not spending, because they can simply not, they have to default on whatever credit they have, and so on and so forth. These are the things that down beneath is actually working. So this is not as tellable a story for us economists, or for me to explain, but that is actually what's happening. Then you'll see on the headlines level, you'll see that there is something going to some fallouts because of all the micro things that happens in the background. And I think this is what we're going to see later on also. All the things that right now there are companies out there that will be struggling more and more, and financial institutions. And I think Japan, there's things going on in Japan. I'm just saying it. I see some of the financial institutions in Japan just breaking lower here to a degree I do not like to see. And Mitsubishi is one of them, and I see that they are 5 times Lehman Brothers. I'm not saying they're going to be it, but I can just see that there are some breakdowns that I do not like. Could that, be a trigger into the rest of the world? definitely could, it could be the fuse of a bigger thing. So the black swan will be the moment when things have been deteriorating for such a long time in the real economy, and it bleeds into the financial sector, and then the financial sector will start to unravel, and there will be some big fallouts. And that is what we call the black swan. But actually, they're not so black. They're not even gray. Actually, we can look at them. We can look at where they are, and they will say, well, this is happening because of the economy. So people should pay more attention to the real economy, to the business cycle, and not all the finance stuff, which I know that the bankers and many analysts likes to talk about.
Yeah, you raise a lot of good points, and quite often when we have one of these black swan events, it's something that no one sees coming. And maybe it has to do with commercial real estate and this work from home thesis, right? Because a lot of, like, I live in the city of Toronto, and even on a Tuesday, Wednesday, Thursday, maybe 60% of the people are going into the office. So there's a
Yep.
lot of empty office buildings, not only in Toronto, but in major cities around the world. You got to wonder what sort of impact that's going to have. Or maybe it's private equity. There's been so much growth there in the last few years.
Yeah, I agree. And I think private equity will be one of the places because private equity is where the yields have been so low, and you'll see that people have been searching for yield and trying to find, and then coming up with any kind of unicorn, hypothetical unicorn, and everybody was searching for that. Oh, who will be the next unicorn? And then you'll see it's simply just distortion of capital, because people are then saying, okay, find me yield, dear private equity partner, and then they will go out and trying to figure out some kind of investment where things could be going well and based on certain assumptions, and then you'll see that it's actually just the business case may not be as good. But you cannot say that if you're a private equity partner. You need to look into things and say, well, of course I can find value, I can find yield for you, because otherwise, what is it that you do? So I think that this about the yields being so low for such a long time is really what has been causing the distortion, constant distortion of things. And again, crypto is also a part of that. It's also a distortion of capital. And the amount of, I mean, if I'm getting it right, I think crypto will reach a size of 6.67 trillion in size before we get to the top of this within a few months here. And I know that sounds crazy, because I think it's only at 800 billion right now. So I think it's going to be a massive move here coming weeks and months. But that is also distortion. And that distortion, I mean, when that's unraveling and people find out, well, wow, there's no value here. Then they pull out the money, and then it's just a black hole. And so these are the things that will create a lot of havoc in the financial sector. And these are the black swans. Oh, we couldn't see that. How could we? I mean, you can, if you look to metrics, which are things that we have been looked at for many years, but actually we now deem unmodern. Now they are not modern, like the Warren Buffett indicator. Oh, you can look to that because that was something we used in the old days, but that doesn't comply with this world. It's simply there where the insanity takes over, and that's why we will have these black holes.
And when you look at private equity, or when you look at commercial real estate, the one institution that's kind of holding the bag are the U.S. financials, right? They have exposure to both of these segments of the marketplace. So if the commercial real estate market starts cracking, or private equity, like, there could be some real problems in the U.S. financials.
Oh yeah, but absolutely. But I think they both will. They both will crack, and crypto will crack, and the stock market will crack. So you can try to put that all together. That's why I've labeled it the everything bubble, because I look everywhere. It's a bubble, and it's so big that I think that when things are starting uh, to unravel, it will just be a lot of value that will be lost everywhere you look. And of course, the Fed will try to counter that, but the size of it's unbelievable. As we said, it's twice the size of the U.S. economy. That is what we're talking about in terms of the market valuation right now. So it's gigantic, and of course the Fed will try to do its utmost, but people will be faced with there will be margin calls, there will be calls for closing of credits, and so on and so forth. All these things, liquidity shortages and all that. So when that starts to kick in, well, then things can be pretty bad. And I think all these things that you mentioned here will be the part of this crisis that we're going to see.
So Jamie Dimon, the head of JP Morgan, always has interesting comments, and he was recently speaking, and he said that he believes higher inflation is still an issue, and we have more inflation coming on the horizon because of deficit spending, and also because of massive infrastructure spending that the Biden administration has been undertaking. And he's gotten concerns about not only inflation, but he said stagflation can also be a problem. That is a slowing economy
Oh, wow.
and still high inflation. What are your thoughts on this?
That's my call. And you can go back and take a look at my tweets also. I'm saying deflation and then a bounce, maybe a quick, good bounce, and then stagflation. Why is that? Because deflation is now coming. The deflation is what is the Fed is now taking the air out of the economy and is going to crash. That's the first part of it. And then the next part of it is going to be that's going to be when the Fed then induces all that money again, because they will come back in. And this is what people are saying. But Henrik, you don't understand it, because the Fed will save the economy. They will induce all this money, and then all of a sudden, you know, the magic trick will be done. But the thing is, even whether it's a financial stimulus or it's monetary stimulus or fiscal or monetary stimulus, you will see that the money needs to start working. So in order to get the multiplier to go, which means that the money that the Fed hands out, or let's say in terms of the credit that, sorry, the interest loan payments that we have to pay that are going to be less because the market yields are dropping, rates are dropping. Well, you and I need then to decide whether we want to take those $1,000 out and then say we're going to spend this. And if we, because of the high inflation we have seen, high market yields or interest rates we have seen, and also the fact that maybe I lost my job, will still say, oh man, I got $1,000, I'm going to go spend it immediately. If that does not happen, or I only spend a fraction of it, then the whole multiplier does not exist. That means that that's the whole part of the stimulus. That's the multiplier going higher and higher. So if we sit on that money, say, you know what, I'll sit and talk with wife back home and say, well, I probably would stay, to keep this money in my pocket for now, because, things have been bad, and I've been hit by inflation and so on. We have been hit by inflation. So let's keep the money in the pocket. Well, then the stimulus does not work. And the problem is then, if they induce a lot of money into the financial system, and they will, because what else should they do? That money will start to find a way to circulate. And that is where it can find into a commodity kind of bubble that I see these can be kicked off, because the money will. Any investor will look at, do we want to invest in equities where we can see that actually the demand is not there and the earnings are not there? No. Do we want to invest in bonds, and we can see now that the inflation is actually on its rise again because we've induced this? No, because bonds are not doing well. So you don't want to do that. And actually, this is not it's a phenomenon we haven't seen since the 1970s to some degree, because we didn't see the stag part. But after Corona, we actually saw a part where we saw 9 months, I think it was, where we saw both bonds and equities declining. And in that environment, where do you put your money? If you have that in a situation, and that can happen, that's what I think Jamie Dimon is also talking about, is that in that environment, you'll actually see inflation starting to move up, because the money may start to circulate into commodities, in the financial sector, but does not trigger the multiplier effect in the real economy. That's the problem. And in that world, you have limited powers as a central planner, or whatever we should call them, as an administration, because if you start to stimulate, then you'll just stimulate the inflation higher. So the only thing you can do with that is that you wait it out, but that's going to be costly on political, societal terms, or you do some very structural changes to things. So I see stagflation as well, and I'm talking about this. I think I mentioned it also in an interview with Raoul Pal in January of this year, and I can remember that Raoul has said, "Oh, stagflation. Where did it come that from? Where does that come from?" Actually, that's been my thesis all along. Deflation first. Bounce after the Fed comes in, because of course the market will react in the beginning, but then realizing that this is actually not turning the real economy, and that's why we get the stagflation. And the stagflation part will be the worst part. The deflation part, we have a cure for that. We have a cure where we can say we'll just print money or do whatever, just stimulate. But the moment we still got to get into the stagflation, that's the moment it gets worse. It gets really bad. And that's why I've also said it's the worst crisis since 1929, because that part we have not seen for many, many years. And I think with the size of bubble we have right now, it can run for a significant amount of time.
So I want to digress for a moment and just talk about inflation, because there's still pockets of inflation out there. So our national airline, Air Canada, the pilot union was threatening to go on strike. They just reached a tentative deal this past
Hmm.
weekend, and they got a 45% bump in their pay. 45%.
Hmm.
And we saw the same thing last year, I believe, with both Delta and United. But do you think the price of airline tickets are going to be going up after that?
Yeah, but that's the problem, that you'll see from a supplier side, you want to increase prices, but from a demand side, you're not ready to buy that. So you'll see that struggle between buyer and seller, and normally the buyers are winning because it seems like, if there's no demand, it may be that you want X amount for your ticket, but you rather not have the plane standing on the ground. So that's why it's going to play in a hard into the to businesses around. And I think it's not just in the airline business. It'll be in a lot of businesses around the world where there has also been a lot of capacity expansion after Corona, because everybody was doing well after all the stimulus. I mean, guess what? They stimulated the economy by something was bigger than the Corona. Sorry, the martial aid after the Second World War. And guess what? Of course, everybody's doing well, because that is what stimulus does. I mean, it stimulates the economy, so everybody's doing well for a certain amount of time. And this is now we're getting to that point. So I think, yeah, I think there are pockets of inflation, and that's because the inflation is lagging is a lagging indicator on the economy. Because when things have been running hot for some time, then people are saying, hey, we need our, to be able to buy what we used to buy, and then we have to have this ramp up in our, wages or whatever it is. And also because products that have been produced have had a higher price because of higher price on the commodities of the intermediaries. So things will need to go through the value chain before inflation really comes through, or the deflationary pressure. So I think inflation pockets are there now, but they will be suppressed. And if you look into 2007, you actually saw inflation going up into the last phase, even into the recession. And then it just came crashing down. It was one of the worst deflationary busts we have had. And this time around, it's the same thing. We have kind of inflationary pressures, as what you're mentioning, but the CPI numbers are still below what we saw in 2007. And I think the deflationary pressure this time around is much, much bigger. So I think we're going to get a very big deflationary crush, bust, and the Fed will react, and then we'll bounce, and then we'll see a stagflation.
So the two largest expenses of any airline is labor and fuel. And thankfully, the price of oil has been slowly decreasing. It's around $70 a barrel. I think it got down to $65 a barrel recently. But what are your thoughts on oil? You've been very bearish on it in the past. Where do you see the price of oil going?
But I think it's on that way, on that path. I mean, not in a straight line, but I've called for $10 on gold, and I still see that, and it's just falling exactly as I've been expecting. It's quite eerie to see that charts can actually do that. You can look at them and say, well, where are the price ranges, and where will you see it heading? And I think that you are going to see oil coming down a lot, and it'll be demand driven. It'll be demand driven from across the world. So I think there is. And that is part of the deflationary bust. But again, that until that point, and whenever the Fed then steps back in again, at that point, I'll become very bullish on oil. And I think oil will go up a lot. And in the next cycle, like with gold and everything else, I think in the next cycle coming after the deflationary bust, after Fed's response, we're going to see commodities move up like nothing we've seen. It's going to be a commodity cycle, bull cycle of, gigantic proportions.
Now, you mentioned $10 oil, okay? And that's a significant pullback from its current level. And the last big pullback we saw in, I believe, Q1 of 2020, it got down to $25 a barrel, which was very cheap. How do you get $10 a barrel?
It's the structures, it's the price structures, the technical structures, how far it can get, and how far it can low, so how low it can go. So I think when I'm looking at it here, it's the BTI that I'm looking at, and WTI, and I think the reason, the narrative behind is simply that you're going to see an economy that is coming to us almost a standstill. It's not going to be as bad as in the Corona situation, because I don't think we're going to get lockdowns and things. But I think it's going to be really bad from a real demand perspective. There will be very little demand on oil in a situation where I think an unemployment rate can move up very, very drastically. And again, the Fed has been keeping the brakes on for too long. And when you do that, there are going to be ramifications, and we're getting into that. We're getting into that, and that's I think the start of the recession will be December, could be January, but it'll be around that timeline, and then the Q1 next year will start to show. And coming half of 25, things will be we'll be in a completely different situation. So oil will come down, the demand and the excessive demand we've had will now come into an excessive under demand, and that I think is the phase we're moving into.
And once again, I don't mean to beat a dead horse, but $10 a barrel, like that's down 85% from its current level. That would indicate, given that oil is a barometer of the global economy and how the economy is doing, that would indicate that the global economy is going to be going into a depression-like state.
Yeah, but I made the call in 2019 on oil as well, and before the corona, I could not see the corona crisis because that it would be a the crisis of a pandemic. But what you could see back then, you could actually see that everything was playing into a very strong recession. And again, I can only point to the charts and say the charts that I'm looking at suggest that with the kind of extensions I do, that we're going into around $10 on oil. It's going to, but it's going to be a spike down, but I think we're going to reach that level. And that will be a very bad crisis. That's what I'm trying to say. I mean, it's going to be really, really bad. And the Fed is so horribly late for this that they are part of the problem. At this point here, they should be looking into actually starting to stimulate long time ago. And still, with their Fed fund rate, what it will be at when when they've done their cut on Wednesday, it will still be way too high for the economy at this stage here. So I think it's not so difficult to understand that the car will come to a standstill if you keep your foot on the brakes. The car will come to a standstill, and that is what we see because people will, people also start to lose their jobs. There'll be less demand from that side, and that less demand is going to trigger, shutdowns in the businesses. That's the negative spiral. That's a deflationary spiral. So yeah, I am saying it's going to be a significant, and it's not, as again, it's the worst since 1929. I really mean it. It's going to be bad.
So let's talk about the cryptocurrencies, more specifically Bitcoin. You've brought this up a few times. It's currently trading in around $55,000 to $60,000, depending on what time of day you're looking at. But in the past, you have said you see Bitcoin going to 110 to 115,000 in this rally, this blow off top rally that you refer to it as. Has anything changed in terms of Bitcoin and where you see it going in the coming months?
No, absolutely not. And I think again, 115,000, 120,000 around that level. Maybe 110 could also be that, but it's that range. And the reason is that you are in Bitcoin, in the cycle of Bitcoin, you actually see that they're going into the final top. You'll see the last 5 to 7, 8 weeks is just explosion. It's just a pure explosion, and it's because people are coming late into the phase of it and say, oh, now it's starting to move up, and I missed out some of it, and then it'll just be pouring in, and then some of it will move into, you'll see the rotation into altcoins, and all this happens really, really quick. And I think it will happen even quicker this time because you'll see that people will start when Bitcoin moves above 69 to 70,000, you'll see people actually saying, oh, actually everybody thought it was actually dead now, and now it's actually alive again. And then you'll hear calls of 250,000 or a million or whatever, and people buy into that, and you'll see that move up higher. So I absolutely do see that, and I think we're very close to that move setting off. There are some levels that need to be crossed. 69, 70,000 is one of them. And when that gets crossed, I think a lot of people will be caught on the wrong side of this move. And that move is going to be, but it's going to be short-lived. I think people thinking, yeah, 25, 26, 27, just go on. And they come up with this, the Bitcoin cycle. But guess what? It's not Bitcoin running the economy. It's the economy running Bitcoin. And I think if you're going to see the kind of deflationary bust that I'm talking about, and oil at $10, that's not something that Bitcoin is going to like, because that will be a recession, and people will lose their jobs. People will be selling off to get liquidity. And that's going to happen. But for now, I'm very, very bullish the crypto market, and I think we're going to have a great blow off top. And when we talk right at the top in a couple of months' time here, you'll see that people saying, "Oh, but Henrik, you must be wrong." You can see that the Fed will be all behind this. And I think actually one of the reasons why I could see that explosive development is actually maybe all of a sudden there will be some it'll reveal itself that the Fed is as late as they are, and then they can come out and maybe they'll do another 50 basis point if they do 50 now, but another 50 maybe also in October. I mean, it could be something like that, or is it? I don't know if remember this if it's in October when it is actually. Sorry, but as the next FOMC meeting. So I think that kind of narrative will fuel the boom until the moment where the real economy catches up with the markets, and there will be a time for that.
And where do you see, okay, so let's just assume Bitcoin goes up to 110 or 115,000 during the pullback that you think is going to come. Where does it go?
Mm-hmm.
Does it lose 70, 80% of its value from those levels?
You're going to force me into this now? Let's just say it's going to be a very big drop, and I think people are not really realizing how far it can go, how low it can go, because again, Bitcoin has never met a real economic crisis. It met something that was similar to it, and for a day, someday I could explain why I think there was a different situation into the slowdown of COVID, and why that did not really unfold in the full, even because the Feds jumped in and all that. But I think that Bitcoin is going to crash to very low levels. Let me just put it like that now, and then because I don't want to scare a lot of people away now by saying oh, he's just crazy because he cannot go that low. But let's just say I've set very, very low, and I can one day explain why I think that it's significantly lower than what people would think, because it will not just be a pullback, it'll be a crash.
Well, we saw many stocks after the dot-com bubble lose 80, 90% of their value. So anything's possible, right, in that environment.
And that range would absolutely be possible, yes.
So I got to ask you about gold, something I hold dear to my heart.
Yeah.
And gold's doing okay. It's up 25% on the year, and slow and steady. Nothing, it's not Bitcoin-like, which is up, I think, 40 or 50% on the year. But what are your thoughts on gold? Does gold keep ticking higher in this environment? Because just as a reminder to our viewers, there's an inverse relationship between the price of gold and also the US dollar and interest rates. And with this pullback that we're seeing in interest rates, we're getting a pullback in the dollar, and therefore gold is moving higher. Where do you see it going in the coming months?
So part of in inflation, gold does not do well. It does not. And again, I said it many times also, I think gold is the outlier here, because if you look at gold, silver, palladium, platinum, even gold miners, look at Barrick Gold for that matter, for the one gold miner, the largest gold miner of the world. Where's that at? Anywhere near the all-time highs? No, it's not. And why is that? Because I think the price of gold is being carried away by actually people thinking, oh, gold will do fine because we're going to get inflation. But if we're going to get first deflation, then gold and silver will not do well. And there is a very short period of in 2008 where you had from March until September, you saw that gold actually crashed by 35%, and you saw silver crashing by 60%. I would not be surprised to see gold from current levels. I said 2,500 to around 2,700 could be the range where we could see gold. Let's see if it can cross 2,550 here, with some strength, then we could be heading to 27. But I think we're getting closer to that top, because we're getting closer to the moment also where we'll see the deflationary forces start to play out. I think gold have been front running things in the way that it's not supported by all the others. So I think gold has a downside target, which will be from 35 to 55% in the crash that comes from wherever it tops out, and wherever will be probably between 25 and 2,700. So that is what I'm seeing. People do not like that, because they say, yeah, but in a crisis, gold will do well. Actually, it does not. The finest value of gold is to get liquidity for you if at the moment you need it. And that will, if we get a liquidity crisis, if we get Dixie to 120, which I think will be the case after we have reached 93 to 95. Let me just put that first. After that, we have the deflationary bust, which will push Dixie to 120. Gold will get crushed. Silver will get crushed, and I think you'll be much better levels. And I think that is where gold actually is not right now actually being the outlier compared to the rest of the pack. And let's see, because that could also mean that gold will have the biggest relative crash of the rest of them. Even though I think silver is going to crash by 60% again this time as well. So I think it could be rather big for gold, and this is not the time for gold. The time for gold will be stagflation. That is the time for gold. So the moment when we see the Fed coming in, and if they are so they start a stagflationary development, well, then gold will do fantastic. And then I can see gold 10,000, 15,000. These levels will not be a problem.
Yeah, you mentioned you're right about gold. The physical gold is doing well, but many stocks are not. And if I look at Newmont, which is the world's largest producer, it's up 30% on the year. So it's doing a little bit better than the price of gold. But given, the reason why you buy gold equities is because you want that leverage, right? So it should be
Yeah,
up 2, 3, 4 times. Barrick, the
exactly.
second largest producer, I think it's up maybe 10% on the year. A lot of that
Yeah.
has to do with jurisdictional risk and just in the countries in which they operate. But basically, you're just saying you're expecting a big pullback in the price of gold because you're expecting this massive pullback in the economy, and that's just going to hit all asset classes. It doesn't matter if it's real estate, if it's oil, if it's gold, whatever it is, it's going to be for sale.
Sorry. Yes, exactly. That's what's going to happen. So I think that everything will be for sale in that period, and gold will be one of the things. And again, in that period, it'll be all about cash. It'll be US dollar. That is the only real liquidity. But I am in the long term. I'm a gold bug. I have again some targets on the gold miners where I think this could be good leverage play, but I don't think this is the time now. Not going into something like this and with so high valued, overvalued markets. If we're going to see that sell off and a deflationary bust that I think we see, then gold will not do well. But could it move a little higher from here? Sure, but I think still it's too high for the environment that we are in.
Okay, so let's summarize everything you have said here in the last few minutes. You're expecting a further rally in the S&P and the Nasdaq, so 6,100, 6,200 on the S&P, and this is going to be what you're calling a blow off top. Then you expect a big pullback in the economy and slowing in the economy and the GDP. We're going to get an increase in unemployment numbers. This is going to lead to deflation. Then the Fed is going to react, and essentially it's going to be too little, too late out of the Fed. And then you think ultimately we're going to go into a period of stagflation.
Yeah, maybe at that point the Fed will no longer do too little, too late. At that point, it'll just be very too late, but it'll be too much too late, probably like that. So you'll see that the Fed will react after that deflation, but it'll be like a massive kind of thing, and the biggest that we've probably seen because they want to stop the holes in the economy. So I think that is what but pretty much yes, that's what we're going to, and that will move the economy into a stagflationary after an initial bounce in the markets. Yeah.
So Henrik, given the scenario, how do you suggest investors prepare themselves for what might be coming in the coming months?
Well, of course, there's many ways to position themselves, and into a deflation, it will always be like again, it'll be for now. Let me say what I am. I'm fully risk on right now. Also in crypto and Bitcoin miners and so on, and it's to have a leverage play or a strong play on Bitcoin's move that I see. When we get to when I think what it will be the top, and then I think it's about, first of all, cash can be good at that point, and especially if it's in greenbacks, so US dollars, but also treasuries, and I think treasuries already now could be fantastic play also, because we are starting to see a relative strong performance of that versus stocks also. And then I think into the deflationary phase, that will be it. Then there will be other things. It will be about having for businesses, it'll about having credit lines in place, because if you do not, you'll see a freezing of credit in that environment. So that is important. And then it'll be also about understanding that the moment when the Fed moves in, yes, then things may come back to seemingly coming back to normal, but actually it will maybe just be a bounce as I see it. And that bounce may last 6 months, but eventually we could see more decline. And in that environment, it's probably about gold, silver, and the likes, because I think that is when the dollar really is going to take a tumble. So I think it's going to be very difficult. It'll be a very difficult environment to be in. It'll be very whiplashy. So a lot of investors will be caught on the wrong side, either going into the blow off top, either when coming into the deflation and so on. So it'll be very difficult, most difficult environment we have seen for many, many years.
Well, Henrik, that was a fascinating discussion as always. And if someone would like to follow you online or learn about your services, where can they go?
They can go to my Twitter profile at Henrik Zeberg, and they'll find links to where to find me.
Well, once again, Henrik, thank you.
Thank you for having me on.